2 p.m. in New York at 7 p.m. in London. Live from Bloomberg's World Headquarters, this is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs.
And good to have Romaine back because it's Monday. Market hopes are retreating. U.S. stocks go from green to red. That as investors gauge chances for a pre-election stimulus deal. Treasuries slipping along with the dollar as earlier optimism on U.S. fiscal spending and China's economic bounce, well, they fade. Meanwhile, a deadline is set. Pelosi gives the White House a stimulus ultimatum. Reach a deal by tomorrow or we'll lose any chance for more fiscal stimulus before Election Day. Now, the Speaker is set to speak to Treasury Secretary Mnuchin later today. Opposition hardens to the Republican-controlled Senate. And navigating airlines through a crisis. Europe's surge in COVID cases threatens Delta's efforts to, kickstart lucrative transatlantic business travel. We shine the CEO spotlight on Delta Chief Executive Ed Bastian this hour and all week. All that and so much more coming up, Romaine.
Yeah, Caroline, and you know how hard it was for you just there to pronounce stimulus? Well, that's how hard it is for investors to believe that it's actually going to happen here. I'll take a look at where the markets are right now. The S&P 500 down for the fourth day in 5, and really, if you look at what happened on Friday, pretty much down 5 straight days. We haven't had a meaningful move since that 1.6% jump that we had about a week ago last Monday. All of those gains have been walked back. Right now, all 11 sectors in the red here. Nothing really getting the bid. Energy had been a little bit higher at one point on the back of some gains by Halliburton, as well as Conoco and Concho. But as for the rest of S&P, really no bids coming in. You got Netflix, Home Depot, Nike getting bids, but all of the other big tech names really selling off here. You did see a pretty interesting milestone here over in Japan earlier today, Taylor, with the Nikkei actually erasing its losses for the year. So there is some optimism overseas about the trajectory of U.S. fiscal stimulus, and that's getting a bid there overseas.
And you see the optimism filtered in, at least through the economic data that we got this morning. Take a look. If you want to see a V-shaped recovery, it's in the housing market. You guessed it. Take a look at this. U.S. home builder confidence in October rising to a record 85. Traffic remains high, record low interest rates keeping demand strong. This is my favorite quote. However, quote, it is becoming increasingly challenging to build affordable homes given shortage of lots, labor, and lumber, creating lengthening construction times. You really see the demand-supply dynamics in there, Caroline. Flip up the board finally, because what this means is you are seeing more of a divergence between performance of these global equities, U.S. in white, Asia in yellow, really outperforming Europe, and then, of course, your UK, as we face multiple battles on different fronts. It is the K-shaped within the equity markets that I'm looking at.
That's a really great chart. Let's delve into these moves, whether they be here in the US, what's happening in Japan, of course, what's happening in Europe. We keep it global. We want to focus in on what it means for the US economy. Chuck Lieberman's with us, co-founder and chief investment officer at Advisors Capital Management, who joins us from Ridgewood, New Jersey. Chuck, your main concern today, is it all about fiscal?
Yeah, it is, although I'm not terribly optimistic. There are good political reasons for each side to fail to come to a deal, even though there are good economic reasons for a deal to be struck. So it's kind of frustrating, and it's likely that this will pass the election and perhaps even go into next year.
All right. So, I mean, we may have to wait a little bit longer here for fiscal stimulus. Right now, Chuck, we are getting into the heart of the earnings season this week and next week. Do you have any optimism here that the numbers that we're going to get out of some of these companies are going to be enough, I guess, to keep investors satiated, at least for the next few months?
Yeah, I think the economy has actually done a bit better than we expected. So the numbers have been coming in on the plus side, which is great. Looking ahead, we're going to get a GDP number for the third quarter. Obviously, that's still backward looking, but it's going to come in somewhere between 30 and 35% to the upside, which is dramatic. For the fourth quarter, we're probably looking at 3 to 4%, so slower, but that's partly because of the lack of fiscal stimulus. But interest rates are still very low. That's going to keep the housing market quite strong. We're seeing capital investment come back. We're seeing consumer optimism. Consumers have the finances to be able to go out and spend. They're doing that. So the economy is continuing to open slowly, and that'll keep things on a positive trend. But it would be nice to have more stimulus to move the process along that much faster.
Chuck, we love getting you on the program because you give us some individual names. One that really sticks out to me as we are in the middle of earnings season, Wells Fargo, a company that's been, beaten up, and really the financial sector as a whole under pressure. Why Wells and why the financials?
Well, let's start with the financials. So the financials are really dirt cheap. This is a tale of two markets, two cities. Technology and everything that's benefited from the pandemic is through the roof. The financials and other things that have been hurt by the market, by the pandemic, are basically dirt cheap. So I have no difficulty finding really attractive, cheap stocks. So to start, let's talk about the big banks. We like all four of them. JP Morgan, Citi, Wells Fargo, Bank of America, they're all extremely cheap. Take a longer term perspective, 1 or 2 years, all of these things should be a lot higher. They've built a lot of capital. They're trading at low PE multiples. The market is anticipating massive loan losses, but they've built massive reserves against those losses, and those losses will not come for a while. So we think that these banks are very, very attractive. But it spreads throughout the entire financial sector. So if you look at some of the insurance companies, take a company like Lincoln Financial, it's trading at something like 4.5 times next year's earnings. That's ridiculously cheap. They can buy back a ton of stock, dividend yield of 4.5%. These are really, really attractive bargains, and there are a lot of them out there.
Chuck, you've been an academic. You worked at the Federal Reserve Bank of New York. You've moved across and helped found, of course, the business now you're in. When you look at the environment with which we stand, how hard is it to even determine fundamentals right now? How much are we dependent on headline risk, and how does that change the way in which you invest?
Well, the headline risk is really dominant in the very, very short run, right? So every time we get another headline, it moves the market, and sometimes pretty sharply. Get away from that daily volatility, and I think the fundamentals really have been driving things. So I talked about, the technology stocks being doing extremely well. I even have a joke about saying that the guy with one leg in a tub of boiling water and the other leg in a tub of ice water, on average, is comfortable. Well, that's this kind of market. But when you look at the pieces are a lot more interesting. So you can make a very good case that Amazon, a very expensive stock, deserves to be where it is, because obviously they've moved a lot of goods through that inventory, through that system. They've accelerated the rate at which people buy online. People are much more comfortable doing it. Their profitability has increased. Their sales have increased sharply. They're expanding pretty rapidly. You can make a strong case for a company like Amazon or Microsoft or Apple, even though they have benefited. And then on the flip side, you have a lot of companies like all of those financials that I mentioned just a minute ago that are really dirt cheap, that have tremendous upside, that are being almost given away. And I think those offer tremendous value.
All right, Dr. Lieberman, and always great to get your insights. That's Chuck Lieberman, co-founder and CIO at Advisors Capital Management. Now, coming up here on this program, a stimulus shift. We're going to talk about how a pre-election fiscal stimulus deal could actually happen. Maybe. And we're going to head to the other side of the Atlantic, where negotiators over there try to strike a deal. Brexit, remember that? Why British officials plan to water down Boris Johnson's Brexit bill in order to revive talks with the EU and getting back to business. We're going to hear from the CEO of Delta Airlines on how the company is working with the CDC to get travelers back in the air. All that and more coming up next. This is Bloomberg. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. And first up, Kansas City Southern getting an upgrade to outperform over at BMO Capital. The analyst citing the potential for significant volume growth over at the railroad, saying that the company faces fewer hurdles than its rival U.S. Rail Network. Shares there up about 1% on the day. Next up, AMC Networks, the movie theater chain, downgraded to underweight from neutral over at JP Morgan. The analyst saying worsening fundamentals ahead, and says that the company doesn't have a true competitive direct-to-consumer streaming strategy. Shares there down fractionally on the day. Finally, GoodRx drawing mixed reviews on Wall Street. This, of course, following its IPO last month. Bank of America initiating coverage with a neutral and $58 target. The analyst saying that still early user penetration leaves room for growth, though the stock currently priced with high expectation shares down 4.5%, and those are some of your top calls. Taylor?
Thanks, Romaine. As we move from some of the idiosyncratic movers to just what's moving the macro indices, a large part of that, of course, can be all about fiscal stimulus, when we're going to get it. Take a look at this chart. This is a monthly basis, so we're not in October yet, but this shows fiscal policy uncertainty in white falling, really, as the markets are pricing in when, not if, we'll get fiscal policy. In the meantime, we heard from Janet Yellen, former Federal Reserve Chair, talking about the lapse in fiscal policy. Take a listen.
We need support for the economy, both for monetary and fiscal policy. And monetary policy has already done a huge amount. Fiscal policy response in the United States has been extremely impressive, but actually it's much larger, the fiscal support, than what was done after the 2008-9 financial crisis. But the fiscal support has now lapsed.
For more, we're now joined by Bloomberg Chief Washington Correspondent Kevin Cirilli. Kevin, we know talks continue, but what is this new Tuesday deadline set by Pelosi?
Well, look, I think former Fed Chair Yellen just right there outlined just the incentive and the push that Washington is feeling from top former Fed officials, current Fed officials, the C-suite, Main Street, everyone calling on their Taylor to be some more stimulus. Now, Speaker of the House Nancy Pelosi, as you just alluded to, saying that she wants to get to some type of deal with the White House, with Treasury Secretary Mnuchin over the next day or two. And candidly, President Trump is saying that $2.2 trillion is still significantly less than what he would actually like to see. For Senate Majority Leader Mitch McConnell, the top Republican in the Senate, who has pushed for $500 to $700 billion, he's got to now navigate a conservative caucus, not just in the rank and file, but also outside in the donor class, in the business community, who are scratching their heads and saying, this is so much money and it's not needed at this time. So it is an ideological collision course if I've ever reported on one.
Yeah, and I'm curious, too, given just how much of a collision course this seems to be, do you think there's going to be any will to even try to push this through, particularly with the fact that the Senate still, of course, has the Amy Coney Barrett vote that they want to push through as well?
Romaine, great point. Calendar time, always tick-tocking away. But I think when from the broader standpoint here, look, there is political incentive for there to get to some type of an agreement, especially for moderates in swing districts all around the country who are in tough re-election races. You know, you look at some of the Senate races as well, in which they would like to be able to run in a closing ad argument that they were able to reach across the aisle, do some bipartisanship, and get a deal done. Now, is it doable? Is it actually going to happen? We've been reporting on this round the clock. I'm not so sure that anything is certain as of now. It still remains, based upon the conversations that I'm having, a matter of when and not if.
The stumbling blocks, for example, the COVID-19 testing and tracing, what is it that's the nitty-gritty that makes people have pause?
You know, I'm going to keep this quick, and I think it really comes down to funding for state and local governments. I think that across the board, in Republican interviews that I've done, as well as Democrats, Republicans are saying, why should they be on the financial hook for states that don't run their books the way that other states have? In contrast to that, Democrats say that people are hurting, they need aid, they need financial assistance, they need to prevent furloughs and layoffs from government and state and local employees from happening before the end of the year.
Kevin, thank you for keeping us up to date on all things going down in Washington. Kevin's already there for us. And be sure to tune in to Balance of Power tomorrow. David Weston's got an exclusive conversation with House Speaker Nancy Pelosi, all on that deadline. That's 12:30 Eastern. And coming up, ready to make some rewrites? Why British officials plan to water down Boris Johnson's Brexit bill in order to revive talks with the EU. This is Bloomberg.
Last week, I showed Caroline a chart of how Brexit was actually hurting GDP much more than the coronavirus. And so today, Caroline, I made a second chart just for you. Take a look at this. This is all about the pound 3-week volatilities. You can see there in white above the 1-month or the 2-month 10-year. So you're certainly expecting some more short-term volatility around Brexit in the next few weeks, much more than we're expected to see volatility 1 or 2 months out. For more on the Bloomberg Brexit volatility and all things Brexit, let's bring in our reporter, Joe Mays. Joe, what is the latest, particularly around the UK trying to rewrite some of this Brexit bill in order just to get a deal?
Yes, our latest reporting suggests that the UK might be considering, watering down some of the most controversial provisions in that bill, given how badly it went down with the EU and how it could be seen as an obstacle to that ultimate trade deal. And we know that bill is going to the House of Lords in the UK, where it's expecting to face fierce opposition. The debate started today, and so maybe the UK government is taking the view that, well, it could get blocked in the Lords or significantly held back in the Lords. So why don't we just drop some of those more controversial provisions in the hope of getting that bill ultimately through?
Joe, businesses, of course, would like to see an agreement. They want to put plans in place. They want to be able to adjust. How are people reacting to the current on-again, off-again scenario with the EU when really everyone's being forced to hunker down once more, having to try and navigate what level of risk their currently city is sitting in?
Yeah, I think there's a kind of an ongoing bemusement, especially amongst the business community, to this process. There's a big effort put in by all the major trade associations saying, we need a deal, we want a deal. If you don't have one, that will mean tariffs on trade with our biggest partner, and we don't have that clarity about what's coming. However, the UK government is saying, well, there are lots of preparations you can be doing for Brexit, which you will need in either scenario, and that's a message they're really trying to get through because the levels of readiness for Brexit are really quite poor, and that's worrying the government, especially because of the pandemic and how that's depleted stockpiles, it's hurt companies' financial positions. So there's a lot of worry really about, in any scenario, are we ready for Brexit? Probably not.
And what about the EU side of this? I mean, we heard from Barnier not too long ago today saying that he's basically willing to intensify talks, assuming UK negotiators want to do it.
Yes, and that statement by Michel Barnier was met with a rebuke essentially from the UK side, who said, well, it doesn't really go far enough. The UK essentially wants to see a really substantive move by the EU on the controversial issues in these trade talks, like access to fishing waters, the so-called level playing field issues. I think the UK wants to see a big statement from a senior European figure, perhaps Angela Merkel or Emmanuel Macron, really signifying that they are willing to make some compromises here. Because the UK attitude at the moment is they feel like they're being forced to make all the compromises. So until that happens, I think these talks are really frozen, and the UK is saying the EU needs to do more to unblock them.
Is there any sense that this is playing right into the hands of the EU, exactly where they wanted, where any country in the EU who's looking to leave now thinks, I don't know if we should, because look at what a mess Brexit has become?
I think that's potentially an explanation of some of the behaviour by the EU in terms of, like you say, discouraging further efforts to leave by other nation states. I think it will also be fascinating to see how the EU treats the UK from January 1st when it comes to things like customs controls. Will they make it difficult for goods to cross the border, fully complying with their own legislation, EU rules, but just kind of enforcing things to the law and therefore creating that disruption even in the event of a trade deal. And that's what I think really worries the UK government when it comes to disruption at the end of this year.
All right, Joe Mays there giving us an update on what's going on with Brexit. Of course, our Bloomberg Brexit reporter, a title that looks like it's going to have some longevity based on what we know today. Another interesting story coming out of the UK, Caroline, and I thought about you when I saw this. The London Metal Exchange, remember back in March, they temporarily shut down that sort of iconic open outcry trading pit because of coronavirus. They said it was going to be temporary, but of course, now there's a lot of questions as to whether it will ever reopen. Volumes on the exchange are down about 75%. And, a lot of folks are making do with electronic trading. And it kind of makes you wonder whether sort of a remnant, of the golden age, of finance and trading is ever going to return.
Oh, back to the good old days of the 19th century where one just needed spit and sawdust and a circle to sit in. But it would seem nowadays, that's how it all came to be, apparently. It was sawdust on the floor. You used to draw a circle and the Jerusalem coffee house. And that's how it all got kicked off.
With spit.
Yeah, which you definitely can't have in the current coronavirus situation. So, I mean, perhaps, Taylor, we've been thinking this was going to come to an end at some point anyway. It's sort of a bastion to the good old days. But technology was always potentially going to take over.
I know. I love that now we have to resort, bummer, to electronic trading, right, rather than on the shouting match.
This is near and dear to my heart. Remember they shut down all the U.S. ones years ago? Like when I was a kid, I was supposed to go to the library after school. Instead, I would sort of make a left turn and go over there to LaSalle, where the
really?
the Chicago Board of Trade, and all the traders would be out there in front of Jack Schwartz, a big cigar shop, and I'd go out there and bum cigarettes from them. It was
Oh,
good
I thought you were
times.
going to say I used to go and listen to them in the open outcry, shouting, making signs at each other. But no, you're just watching them drink and smoke cigars.
I was a miscreant. That's why I love those guys.
Well,
they were fun.
Luckily, we still have more UK stories to follow up on. I'm winning Caroline's heart right now. Let me start with this one. It's another sign, of course, how the pandemic has upended the economy. Take a look at job vacancies in London's finance industry. They have slumped 54% in the third quarter compared to a year ago. This is all according to recruitment firm Morgan McKinley. And American Airlines has plans to debut the revamped Boeing 737 MAX at the end of the year. It'll be American's first flight with the MAX since the plane was grounded for safety reasons in March of 2019. The airline will fly the plane on a New York-Miami route from December 29th to January 4th. That is still tentative. Regulators haven't approved the 737 MAX to resume just yet. Caroline, those are some of the other stories we're following.
Yeah, just a few of them, but let's keep an eye on what's happening in the broader market. We're currently seeing currencies, well, the pound getting a pop in the hopes of Brexit. Nevertheless, Europe fell lower on the back of hopes of fiscal in the US. We trade off 0.6% on the NASDAQ. This is Bloomberg.
This is Bloomberg Markets, The Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A little bit after 2:30 here in New York. Let's get you caught up on settlement of NYMEX crude futures, right around $40 a barrel. Of course, got that news out of Saudi Arabia and OPEC Plus that they will do whatever it takes to help balance the market. That's putting a floor under prices here, but still no real breakout here to the upside. You're also seeing prices fall on gasoline. We had the latest weekly gasoline demand numbers in the U.S., which showed demand falling about 0.6% in that week. And then at the bottom of your screen, we don't talk about this much, but an interesting rally going on in zinc. Zinc at the highest in about 4 weeks. A little bit of an economic read here, particularly as it pertains to what's going on with the economic recovery in China. Caroline and Taylor.
Yeah, Romaine, I wanted to take a look at the economic recovery, of course, that we're looking at here in the U.S. One way we can do that, I was taking a look at the company called Klarna. It's the leading global payments shopping provider. They have a report out covering January through June of this year. Here are some of the key statistics. Growth in merchandise volume up 44%. They've added 200 new global retailers per day. They now have a total of 14 million customers, and their monthly active app users have now increased 2 times to 12 million, and they're seeing growth 3 times as fast for app installs. So maybe we're all at home or in store shopping and increasingly using some of these global payments providers, Romaine.
All right, well, let's talk to the person who knows the most about this, Sebastian Siemiatkowski. He is the Klarna co-founder and CEO, joining us today from Stockholm, Sweden. Sebastian, thanks for being here. Let's start off with your general business model, this sort of buy now, pay later business model. At least folks here, particularly here in the U.S., have become familiar with it because of those great commercials with Snoop Dogg telling everybody to be smooth. But of course, there is some concerns here about how consumers themselves are interacting with this app. Just explain it to me. Give me sort of the 30-second pitch here.
Well, first and foremost, I really think of Klarna as an alternative payment provider because we offer many different features where paying for this kind of buy now, pay later is just a feature. People use Klarna for other reasons as well. For example, the fact that when you buy with us, you see images of the items that you bought. To get a full digital receipt, you can track your logistics. It makes just e-commerce shopping easier in general. But in regards to the buy now, pay later offer, which is really attractive to a lot of consumers because the tradition way of getting access to credit has been credit cards with 19-29% interest rates if you revolve. And now we're offering a free installments. You split it on a short period of time. It's installments. It's easy to understand compared to revolving. And it actually comes with 0 fees or interest for the consumer. So obviously there's a lot of attraction, especially among the younger generation. That is quite, the millennials and Gen Z have been quite skeptic about banks since the financial crisis and are rejecting those kind of historical models. And they really appreciate this installments, free, easy to use, very clear. You pay off very quickly. So I think that's the reason we're getting to about 10 million users now in the US and 90 million users worldwide. So
I think really not charging interest, the focus on not getting in ahead of your skis basically is important, Sebastian. What's been interesting in the UK, particularly about some of the adverts that I love. I mean, who doesn't love Snoop Dogg in an advert? But they are worried about how that is focusing on the young and perhaps just instilling this idea that you can just keep on splashing the cash. How do you pivot away from that? How do you ensure that people are being encouraged to spend but not spend more than they have?
No, that's a good point. And I think obviously we're a fully licensed bank, right? And so we also have all the regulations to take into consideration. And I think it's very important that we find that balance of when we communicate around the offering and so forth, that, when we offer a buy now, pay later offer, we're also quite, thoughtful about who we're offering it. We have very advanced underwriting technologies that we've developed in the last 15 years. And also we make sure in our app to provide budgeting tools and so forth. So, but again, that's only one feature that we offer. I mean, people are shopping with us and paying directly as well in many markets. And so that's one thing that people appreciate, but there's more reasons for people using us. And in general, we're just trying to think how we make the whole online shopping experience more smooth.
I am curious, what shift have you seen from in-store to online, and are customers telling you that shift is permanent?
Yes, very much so. So I think we obviously, at first I was a little bit skeptical to how permanent it would be, but now I think it's very much the case. Because we work with people like Sephora, H&M, Timberland, North Face, Macy's in the US and so forth. We obviously keep very close to what these guys are telling us. And many of them are getting to a point now where even massive retailers that have been brick and mortar, but that have done well in e-commerce are actually getting to a point where we would expect to see more than 50% of their sales being online going forward. So obviously when more and more brick and mortars get to that point, it's just massively shifting the whole, the category, the industry is just at this point where suddenly the digital channel is bigger than the physical stores. And I think for everyone that has invested and been thoughtful about e-commerce, they're getting to that point. For the people who have really said, have been more resistant, they're now at a quite difficult point of time. And yes, it's very clear that it's not going to go back to previous pre-COVID levels. So there has been a massive shift in the market.
So a big shift here, and a lot of people, of course, now are chasing that shift to try to make money off of it in the way that you have. Do you concern yourself at all with not only the competitive pressures that exists now, but the possibility that some of the bigger players out there in the payment space might try to do and replicate what you do?
Yeah, but again, we have been, I've been running Klarna for 15 years, right? So I was 23 years when I started, and which is good. I have a couple of decades left in my career, and I am very, we're very long-term in what we've been doing. We have competed, for example, with PayPal successfully in the Nordics, in Germany. We've taken over in the UK. We have a higher share of checkout than they do, as an example, among our merchants that we work with. So we feel that we have a much richer product when you look at all the different features. So as customers get to know what we do, we feel quite excited about taking on the big guys in the industry.
You've, of course, come over here working with Macy's. Macy's, in fact, invested in you. So has H&M, so has Snoop Dogg. But you've obviously got people looking to give you cash in the private markets. What about coming public?
Yeah, people do tend to ask me that. We'll see. One day I'm sure it's going to happen. But we also find it, I'm also a little bit worried always about quarterly capitalism, and I think it's quite nice in this industry. We are trying to disrupt the credit card industry. That's $1 trillion industry, and that doesn't happen overnight. We're going to be very consistent about it, and so we also appreciate to some degree the slightly more long-term, focus that we can have as a private company.
Well, certainly as a European, I love seeing European startups that go global and show us the mettle. Sebastian, we thank you for your time, staying up late for us in Sweden. Sebastian Siemiatkowski with us, the Klarna CEO. Coming up, navigating an airline back to normal. Why it could take until the end of 2021 for flying to even resemble pre-pandemic traveling. I put the CEO spotlight on Delta's Ed Bastian. That's next. Stay tuned. This is Bloomberg. Now, the news that the TSA screened 1 million passengers Just 1 million for the first time since March of this year. It underscores the immense challenges facing the airline industry. Now, in this week's CEO Spotlight, we explore just what the new normal of flying will look like with Delta Chief Executive Ed Bastian. Now, we begin with Bastian's outlook on the important lane of, well, business travel and what the airline is doing to continue reopening operations between Europe and the United States.
I think we will have more of a focus on leisure. Currently, that's the bulk of our travel right now. We're seeing about 15% of our normal business volume, so 15% is a pretty dramatic reduction, 30% in terms of total travel, but only 15% for business travel. Businesses are not open now, though. Businesses have not just closed, conventions aren't being held. Any kind of gathering that's a big part of the hospitality industry isn't occurring. So it's too early to tell that to the extent to which business travel will come back, certainly the ramp anyway. But I think 12 months from now, when you think about all of the effort that's being placed, the tens of billions of dollars in vaccine development, medical technologies, therapeutics, testing, tracing, people taking greater care of their own well-being and wellness, and people seeing that the mortality, the rates of mortality continue to drop on a global basis. That all is going to combine at some point, I think, coupled with people's desire to get out and start moving again, to really probably have a nice pickup in travel. Whether it's mid-year next year, I don't know, but when it does happen, we're going to make sure we're doing it safely.
I mean, from a personal perspective, I'm desperate to get back traveling. I'm desperate to cross the Atlantic to get back to family in the UK. Are you seeing innovation from your industry and being supported by government in some way of how you open certain transit lines in between, say, London and New York has been often talked about? Have you got innovative?
Yeah, we're spending a lot of time talking to the authorities, both here as well as in Europe, the local country authorities, the airport authorities, working closely with CDC in the U.S. And I think you're going to see initial steps taken, hopefully here soon. Of course, we've got to watch the virus because the virus right now is surging in Europe, so it's probably not an ideal time to be opening up experimental routes. But I think you'll see pilot routes starting, but it'll be coupled with a pretty significant amount of testing that will enable travelers, when they get to their destination, not to have to quarantine. That's the goal. It's not just the safe transit, which is important, but also the fact that they can enjoy the reason they're traveling, which is to go on holiday or to conduct business or to be with family. If you have to quarantine for an extended period of time when you arrive, there's no point in actually taking the trip. So that's why we're working so carefully with the authorities to minimize the quarantine procedure. And whenever international travel does start to open, it's not as if a green light's going to go off and we're back to where we were. We're going to have to test it slowly in specific markets.
You talk about working with the authorities. Have the authorities, have the government, have they had your back? I know that you've worked hard not to have to take further aid, for example, from the US government, but is more spending needed? Is more focus needed from your perspective?
You know, the lot of conversation in our country around airline stimulus in general for our economy, I do believe our economy needs another round of stimulus. If the airlines are provided a portion of that, I think that would be good to receive. The first CARES Act that we had in our country saved us all the ability to protect jobs within our industry. As of the 1st of October, over 30,000 U.S. airline employees were put on furlough. Fortunately, none at Delta, but on the other carriers. And the ability to bring those people back to work requires another round of government stimulus. I think it's warranted when you think about where we are today in the virus. We're actually, in a position that's far worse than we originally anticipated we would be when we had the initial 6-month stimulus grant. And we've had bipartisan support. There's not a question, whether it's whatever side of the aisle you're on or even in the administration, about the need, the importance, the essential work that our airline industry workers provide. It's really finding a vehicle by which people can agree to get the stimulus out. So I'd say the government, while that's a frustrating point that we haven't been able to find the vehicle, in total, our governmental support and leaders from both sides of the aisle have been very helpful.
Just part of my interview with Delta Chief Executive Ed Bastian. We'll hear more of that very conversation all week as part of our CEO Spotlight. Stay tuned. Romaine.
All right, coming up, a big interview. We're going to talk about your credit score and how it opens the door to car and home loans. Yet the system, of course, locking out millions of consumers, including those who are in the low income or young or black or Hispanic or a lot of other things. What's the alternative? Well, Jason Gross, the CEO of Petal, thinks he has the answer. He's going to join us coming up shortly. This is Bloomberg.
Time now for Bloomberg Equality. It's our ongoing conversation about the bottom line impact of diversity. And well, the focus this week is credit scores and how actually they marginalize minorities. Let's hand it over to Scarlett Fu.
Thank you so much, Caroline. The pandemic has left 10 million Americans out of work, forcing people to rely on credit cards and loans to stay afloat. And of course, this at a time when Capital One and other companies are cutting borrowing limits, hurting those who are most vulnerable. Jason Gross, who co-founded and leads credit card company Petal, pushes back against the current system, and he joins me now. Jason, our current credit score system leaves a lot to be desired in the best of times, but right now people are losing income, they're skipping loan payments. Credit scores, all the same, have been rising. I would imagine that payment holidays from government stimulus is sort of distorting the scores, and things will settle down eventually, no?
Well, I think they will eventually, but the question is, when that actually happens. And what we're seeing today is a tremendous amount of noise in the system, essentially confusing traditional credit scores. As you mentioned, the average score in the United States has continued to go up month over month, even as the larger economy has melted down. It's the opposite of what you would expect to see. And it's left traditional lenders and big banks sort of scratching their heads, not knowing who's creditworthy and who's not, and not being able to make credit available.
So let's bring in the other angle here, because the current credit system also structurally disadvantages minorities, and that stems from a history of banks redlining loans to black borrowers. There are laws against this now, but the younger generations are still paying the price, aren't they?
Yeah, I mean, the reality is that the current credit scoring system has long disadvantaged Black Americans and other people of color. Black Americans today are 2 times more likely than whites to lack a credit score. And when Black Americans do have scores, they're lower on average, even when you control for factors like income. The credit scores reflect the past, not the present and not the future. And as you mentioned, the past includes decades of systemic racism and inequality in the financial system. One example, redlining constrained access to mortgages for Black American families for decades. And without the ability to get a mortgage, these families weren't able to build credit history and credit scores. So, today, the easiest way for a young person to start building credit is with help from a parent. But if your parents were denied access to credit decades ago, well, you could be starting your financial life at a disadvantage. We badly need new solutions to level the playing field and address some of these systemic inequalities.
Okay, so let's talk about some of the solutions. One of the alternatives that you say to the credit system, the credit scoring system, is something called cash scoring. How exactly does it work, and how are you using it at Petal?
Yeah, so as I mentioned earlier, there are tens of millions of Americans, disproportionately minorities, first and second generation immigrants, young people that are new to the system that don't have credit history or credit scores, and they have trouble qualifying for credit as a result. So instead of relying on just credit history, we've developed a more data-driven approach, which we call cash scoring, that translates people's existing banking history into credit history. So the money that you make and the bills that you already pay can help you qualify for credit. It has the potential to make the system a lot more inclusive and also more accurate through market volatility like what we're seeing in the COVID pandemic.
How often does cash scoring tell a different story than the credit score that we currently rely on?
Yeah, quite often, especially in the case of consumers that don't have a lot of credit history. So, young consumers, folks that haven't been well served by the banks, often find themselves in this catch-22, where you need credit history to qualify for credit. But where do you start? So cash scoring can show that people have the ability to afford the loan or the credit card they're applying for, that they pay other bills on time. All of that information exists. It just requires that lenders think outside of the traditional credit score and adopt some of these new technologies like what we're developing at Petal.
So can you give us an example of the credit that Petal now extends to minorities, other credit invisible populations?
Absolutely. Petal is a new kind of credit card company. And we work with a bank partner to offer a couple of different technology-enabled credit cards that are really designed to help folks to responsibly establish and build credit. Our products typically give people access to more credit at better rates than they would otherwise qualify for. That's enabled by the cash scoring technology. And then once people qualify for the card, we provide a modern mobile application that helps people to responsibly manage credit. It gives them access to their credit score, budgeting tools, subscription management, a variety of different things to help people to be successful in establishing and building their financial lives.
One thing we haven't brought up yet is cybersecurity. Obviously, that's a big concern. Fraudulent accounts and identity theft can wreak havoc on someone's credit score. We all know someone that it's happened to. What's the evidence that cash scoring is safer and it's more resilient to against this kind of fraud?
Yeah, well, I mean, the more data that we're using to understand the consumer and who they are, the harder it is for a fraudster to take advantage. This information makes it a lot more clear that you're dealing with the person that you think you are, and importantly, the information that's used for cash scoring. So folks sharing their banking history, they're able to do that directly from their bank to their provider with no credit bureau in between. And of course, the credit bureaus have been the source of the largest data breaches that we've seen in the industry.
And very quickly here, how much does cash scoring depend on banks sharing information with each other? If you're denied a loan from one bank, how much does that, or your account is deemed in bad standing with one bank, how much does that contribute to your cash score down the road?
So I think the key is that it's not about banks sharing information as much as it is about consumers being put in control of their own data. So the information that describes your banking history is actually your property. It's not the property of the bank. So this is the same thing as printing out your bank statements or taking your bank statements that you got through the mail, stuffing them in a shoebox and walking them down the street to a provider of your choosing. We just do it electronically, so the whole process can happen in seconds.
Got it. Jason Gross, thank you so much for your time. Jason Gross is co-founder and CEO of Petal. This is Bloomberg.
p.m. in New York, it's 8 p.m. in London. I'm Caroline Hyde.
I'm Romaine Bostick.
I'm Taylor Riggs. This is Bloomberg Markets, the close.
And the Monday market hopes retreat. U.S. stocks go from green to red as investors gauge chances of a pre-election stimulus deal. Treasuries slipping along with the dollar. That's as earlier optimism on U.S. fiscal spending and China's economic bounce back. They fade. Meanwhile, it's a return to power. Bolivia's socialist movement back in charge a year after its leader, Evo Morales, was ousted and driven into exile with the election of his ally as the country's next president. And place your orders. Meal delivery service Freshly has expanded operations with a new facility in Los Angeles. Freshly CEO joins later as it delivers millions of meals amid COVID. All that and so much more coming up. Romaine.
Yeah, and you were just mentioning the fiscal stimulus or the lack thereof. We had headlines saying Democrats and Republicans still far apart on the language in that bill, and you're really seeing that weigh on the markets right now. The S&P 500 and the NASDAQ 100 right now trading around the lows of the day. Big cap, Caroline, was already not doing too well, but we did see a little bit of strength in some of the cyclical names, but that has now faded as well. You see that reflected in the Russell 2000, which had been green for a good portion of the morning, now down about 1% on the day. The MSCI Emerging Market Index, again, another interesting barometer of risk sentiment, was much higher on the day, now also fading now towards flatline level. And keep an eye on IBM here. Was in the green, now turning red. Going to get some earnings. Of course, a lot of people want to see what's going on with that potential spinoff that a lot of investors are starting to expect, Taylor.
Love that you mentioned earnings. Pull up the board. Let's get right to it because we're officially in the second busiest week of earnings season. Of course, last week we came off of a relatively busy week when we really heard from the big banks and the financials. This week, of course, as you mentioned, IBM, and we've Tesla and Netflix and some tech companies starting to report. But you flip up the board again, because while we're in the middle of earnings, we're also undergoing that rotation, or are we, right, between value and growth. This is the S&P 500 Value Index. Since 2018, it has not broken out of the 1,165 range. That's really been the high water mark. More than half a dozen rallies have stalled out, as you can see there. Today, no better as we really start to roll over, Romaine.
All right, let's bring into this conversation Jason Draho. He's UBS Global Wealth Management, head of America's tactical asset allocation. Jason, I'm not sure if you saw the chart that Taylor had on the screen, but it basically showed that value index really trying to break out and sort of being repelled every single time it tries to make a move higher. I guess the question here is, what exactly are investors looking for that would make them more comfortable moving into some of those value names, moving into some of those cyclical names?
Well, I think the key to get the real value rotation, and this applies to small cap stocks as well, is clear signs that the worst of the recession are over, that the worst of the pandemic is over, and that we can think about having a normalized economic activity, which requires certainly kind of like a vaccine solution to the pandemic, and also more fiscal stimulus. I think that's the key thing that investors are looking for, because at least for the value versus growth trade, a lot of what you can sort of proxy it as financials versus technology. And for financials to really perform, they need probably interest rates to go higher, and also signs of economic activity picking up, because then you can see a real sign of what's going to be driving their revenue and their earnings growth. So until we get that, I think you're going to see these kind of, I wouldn't say them head fakes or false starts, but definitely sort of short periods where value outperforms and then kind of pulls back.
I mean, Jason, are you changing things up much in the run-up to the election as you see these daily moves? Are you trading it, or are you just managing to keep clients committed to the market in some way?
We're trying to tell people to kind of think through some of the near-term noise, focus on the intermediate or medium-term outlook, like 6, 9, 12 months, where when you look at horizon, this whole debate about fiscal stimulus, are we going to get it before the election, I think becomes a little more moot. It's likely we'll get something. The question is more when, not whether we're going to get it. Same thing on the vaccine. It's more of a question, will be kind of more fully rolled out by late first quarter, in the second quarter. If you take a middle of next year time horizon, I think that the outlook looks pretty positive on all these accounts. So I think it's important to kind of look through this near-term noise. It's really difficult to trade certainly day-to-day politics or even medical news, and therefore I think none of us have, at least I don't feel like I have a competitive advantage. Therefore I think for our clients it's best to kind of ride through, think through a long-term plan, but also use the volatility sometimes to take advantage of it and maybe add exposure where they're underweight to rebalance their portfolio. So don't just sort of passively sit back, but use this as an opportunity to adjust your portfolio as necessary.
You mentioned rates before. Do you expect higher rates, steeper yield curve, no matter what happens in the election, because stimulus is a when, not an if?
I think it's directionally the rates are going to go a little bit higher, but I think we have to be careful on how much we think about rates going higher. We're looking at maybe about 90 basis points by year end, which is not much move. It's about a 15 basis point move for the 10-year. And so the direction is higher. Maybe the pace could depend on the outcome of the election. If it's a clear blue wave outcome and we don't get fiscal stimulus before, perhaps in the size of fiscal package will be greater then. So I think the magnitude of the move could be increased in that regard. But even still, like we're talking about a relatively modest move when you look at the context for rates overall, still I think that would help the financials, that would help the value trade.
We're talking, of course, Jason, about America. I switch gears just over to what's happening in the United Kingdom and how long it will indeed be united. There's a breaking news coming from Bloomberg Scoop on the UK Conservative Party, really drawing up a battle plan to stop any signs of a Scottish independence move. The party are figuring out how to avoid yet another referendum on this issue. Michael Gove has been circulating memo, we understand, to small working groups there, but really trying to sketch out a strategy to counter the rising support that we see for Scottish independence. Taylor.
Yeah, thank you, Caroline. Jason, let me pull you back in here. Jason, you were talking a little bit about rates, of course. How are you thinking about dividend yields versus treasury yields? How does the relative value look to you?
Well, I mean, the dividend yield looks certainly more attractive. This is part of the whole kind of TINA argument that when you compare the valuations of equities versus, at least, say, treasuries, the equities still look relatively attractive and cheap. And that's kind of part of the argument for ultimately why there's more upside in equities, because there is this excess risk premium. The key thing, though, is if you're an investor, and certainly investors who are looking for income, is how committed are you to safe income and preserving capital versus tolerating kind of price swings? Because you can get comparable income at this point in time from buying the S&P 500, but you're going to potentially incur huge price swings versus what you're going to get much more modest price swings for if you buy treasuries or even a kind of high quality, say, corporate debt. And I know a lot of investors I talk to, say we want income, we're going to kind of take a little more risk, but when they see the volatility, especially if an income generating portfolio, they tend to pull back. So I think it's, when you think about it, certainly from an investor perspective, you have to understand, like, what are you trying to achieve and how much risk are you willing to take to get that higher yield? Because there is no free lunch. I mean, to get more income, you got to take more risk, but that also means potentially larger drawdowns. And it's a question like, what do you willing to stomach as an income-oriented investor?
So then if you're trying to stamp down that volatility or just remain a little less exposed to it, Jason, are there other asset classes out there that folks can look to where they would get that sort of income stream without some of the volatility that they would have to sort of take on if they stayed in equities?
Well, so one of the things that we like right now is actually senior loans. And recently we kind of shifted our preference from high yield to senior loans. One of the reasons for that is, you take less rate risk, in senior loans. If we do get a backup in rates, all else equal, that's going to hurt anything that's got longer duration, certainly something like investment grade. If we continue to get, a recovery as we expect, you should get some spread compression, and loans look a little bit rich, a little bit cheap relative to high yield. And it's another way to kind of get a more consistent income, certainly relative to equities, because ultimately you're taking sort of similar exposure, risk exposure, because they're ultimately kind of claims on, the company's, revenue stream, except senior loans are higher on the capital structure. So that's one area that we're looking right now. But the key thing we also always try to emphasize is have diversification in your sources of income, because sometimes things move up and others don't, and you want that sort of balance because there are different factors that can drive the income generation of different asset classes. And I think diversification is the key in this high risk but also low yield environment.
Jason Draho, always great to have you on the show. We thank you, Head of America's Asset Allocation at UBS Global Wealth Management. Now, coming up, we get global, a new era in Bolivia, how the country's socialist movement led to a landslide victory in its presidential election. Plus, more effective effort, why former Fed Chair Janet Yellen says fiscal support is just as vital as monetary when it comes to helping the economy. And still looking gloomy, why global central bankers warn that we're still seeing not out of the woods from a pandemic, and all that, so much more coming up. This is Bloomberg. Former Federal Reserve Chair Janet Yellen, well, she's calling for more fiscal support and aid for the unemployed workers. She spoke with Bloomberg earlier on what needs to be done to get the economy in some way back on track.
I did meet with Biden and Harris and brief them about financial sector issues, but I'm not working with the campaign. But you asked me what I think we need to do to get the economy back on track. So I would say what heads my list is dealing more effectively with the pandemic, with the health-related issues, getting the infection level under control through contact tracing, testing, isolation of people who have it. I think we need a much more effective effort than we've had. And if we have that, it'll be good not only for health, but for being able to open up the economy. And we've seen that in countries ranging from Germany to Korea to China that have been successful. And then we need support for the economy, both for monetary and fiscal policy. And monetary policy has already done a huge amount. Fiscal policy response in the United States has been extremely impressive, but actually it's much larger, the fiscal support, than what was done after the 2008-9 financial crisis. But the fiscal support has now lapsed. And so far, spending has held up. Unemployed workers who got that extra $600 a week through the end of July, they use that to stay current on their bills, to support their spending. They even stash some of it away so that they've been able to get through this last couple of months and pay their bills. Yeah. But it's running out, and I think we need to do that. And state and local governments also face huge budget shortfalls. I'm working on a task force with the governor of California to address the pandemic. They face a $54 billion shortfall this year. I think that's very important, too.
So in the meantime, Steve Rasciuto of Mizuho just was on, and he said that if Congress were to pass a $2 trillion fiscal support plan, that he expects the Federal Reserve to potentially buy up all of that in order to help things along. Do you think that that's an advisable step?
So the Federal Reserve's asset purchases, they've not made clear their plans going forward, and I'm expecting them to offer more guidance. But their objective there is going to be to try to keep both long and short interest rates at low levels to support an economic recovery. It is not their objective ever to directly try to help the federal government finance its budget deficit, and that would be a very dangerous kind of support to provide. But I do expect, I think asset purchases have worked. They're holding down longer term rates, and I expect there to be ongoing purchases, but probably not geared to the federal deficit.
All right, former Federal Reserve Chair Janet Yellen speaking there a little bit earlier with Bloomberg. All right, time now for Options Insight with Abigail Doolittle, where Abigail's taking a look at the upcoming election and the markets. What's going on there?
Indeed, we are, Romaine, and to talk with us today is Matt Rao of Headwaters Volatility. Happy Monday to you, Matt, and thanks for joining. And you know, today, of course, is an interesting day because stocks opened higher. The S&P 500 up about 0.5%, but right now down about 1.6%. Uncertainty around stimulus and, of course, the election. So you think the election is likely to be contested, and we may not know who the winner is until December 8th.
Yeah, that's right. And the last time we went through this, or any version of this contest, the courts ruled that 5 weeks was sort of the limit for states to declare a winner, and that would put us at December 8th. So I think many people are rightfully looking past the November 3rd date and trying to think, what does this mean going forward for a number of things, not only who the winner is, but what does that mean for policy, for stimulus, and all of the downstream consequences of that.
And so we have the S&P 500 certainly climbing this year, but even the crucial 3 months into the election climbing. What does that tell you about the election, perhaps even the outcome, and also volatility?
Well, I think people are looking at. We see various intersections of odds even today. One very well-regarded person that we follow closely said that 10% of D.C. insiders thought that there was going to be some sort of a stimulus deal before the election, but the S&P futures market would have suggested very differently overnight coming into today. So I think there's a lot of confusion about, what will policy look like, what are the downstream consequences, and again, we have this agency issue of what are the near-term benefits or drawbacks versus what are the long-term benefits and drawbacks. And I think a lot of the focus is on near-term, multi-day pop in the equity markets based on stimulus. But much of what the results of this election are going to show us are what the downstream consequences are for the next couple of years.
Yeah, and the downstream consequences everybody is talking about, not just of the election, but of course this pandemic and tying the two together. So in terms of how you want to express this through the options market, you're targeting December, not surprisingly.
Yeah, that's right. I think it's better placed to operate in December expirations because you cover the event. That's one of the great things in volatility worlds. If you're going to be short vol, you want to be short up to an event and not including an event. And if you want to be long volatility, you want to capture any potential catalyst for the event. I mean, obviously price dependent, but I think it's important to look out to December. And I think it's also important to think about some of the collisions of events here. If the Democrats sweep the presidency and the Senate, it's reasonable to assume that stimulus will be robust on the fiscal side, but it's also reasonable to assume that corporate taxation is going to raise the average cost of capital and potentially take up implied and actual default rates of companies. So it's a complicated scenario looking forward, but certainly one that bodes well for movement of equities and a volatile market to continue.
Well, Matt Rao of Headwaters Volatility, you will be joining us election week. Very much looking forward to that. Maybe we'll get the SKU index in at that time as well. Thanks, as always, for joining us for Options Insight today. And from New York, this is Bloomberg.
not something you see every day. We're taking a look at the price of Bolivian bonds. Take a look at this. These are notes maturing in 2028, dropping the most on a price basis, the most since May, as of course the socialist candidate looks to be winning the election. It was interesting. Bond markets, at least for now, showing us why you don't vote for a socialist candidate. But for more on this emerging market action, let's bring in Sherry Allen, the host of Bloomberg Daybreak Australia and Daybreak Asia. Sherry, what was the market reaction to this election?
The market reaction, as you can see in the bond markets, not great. The investors were hoping for a reformist candidate, perhaps the likes of opposition leader Carlos Mesa, but that didn't happen. At least the good news, I just spoke to my family in Bolivia. They didn't even realize that the vote that Carlos Mesa had conceded defeat. And that's also partly because they don't follow the news as closely, but because there haven't been so far violent protests or any sort of riots on the streets, something that we saw last year at the end of 2019 when a former President Evo Morales was ousted and driven into exile. Now, as you saw in those bonds, the Bolivian economy has suffered this year, especially because of the coronavirus pandemic. Now they're hoping that the socialist movement with the mass party of Evo Morales leading it will actually really revive the economy. We know that right now the candidate who has come out victorious of this is Luis Arce. He was Morales' finance minister from 2006 to 2017.
So talk to us a little bit more about that. I mean, you know, Taylor sort of just warned us of the dangers of socialism, but wasn't Arce actually finance minister for 10 years? And wasn't that a period of, I guess, pretty prosperous growth for Bolivia, wasn't it?
Yeah, so take a look at this GTV chart on the Bloomberg because it actually shows a growth rate while Morales was in power during 2006 to 2019. And you can see that growth averaged around 5%. Year on year. And that was because there was rising revenues from natural gas exports. And when gas prices fell in 2015, the finance minister, Arce, who's now victorious in this presidential election, he ramped up spending. And the problem, though, now is that you have public debt rising, more than 50% of GDP from about 38% 5 years ago. And then you have the coronavirus pandemic, and you can see in that chart the forecast on the right side is still a little bit muted given the huge fall that you see this year, the IMF projecting an 8% contraction in the economy there. Not to mention that, of course, there's a reason that President Morales was ousted. Institutions were weakened. He was trying to run for a fourth term in office, extending his tenure to 14 years.
Oh, how America loves to make socialism a dirty word. I promise you, it isn't always. Meanwhile, talk to us about what's happening in Argentina, because I was noting that seemingly the bond market not liking the way in which the country, I thought, had been rescued to a certain extent.
Yeah, and in fact, another leftist government here in Argentina, right? And they actually pulled off a restructuring of $65 billion just recently in September. And they actually got debt forgiveness of around $38 billion from creditors. But overseas bonds have just plummeted since then. And analysts saying because there's really no credible plan for Argentina, and you can see the bonds they're just falling more than 20% since early September. We know that Argentina is a serial defaulter, defaulting 9 times in the past 200 years. And analysts saying that most recent defaults haven't really resulted in major policy overhauls, so investors still skeptical.
Sherry Ann taking us all the way around, it would seem, the bond markets when it comes to Latin America. And we wish your family well, that's for sure. The host of Bloomberg Daybreak Australia and Daybreak Asia is going to be on a little bit later, keeping us up to date with the Asian market moves. Right now in the US, the moon music turning sour, off by 1.8% on the NASDAQ. We're still waiting for some sort of fiscal deal. We'd been more jubilant in early trading, hopes of some sort of spending and the look at the Chinese recovery. But Europe closed lower as too. This is Bloomberg. This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick, a half an hour away to the end of the trading day. Look, 27 minutes, 29 seconds, Caroline.
I love it when you're precise. Let's get precise about these markets because the S&P 500, I mean, the moon music really turned sour from about lunchtime onwards today, down by 1.5%. Remember, we're in the green to start the trading day. Hopes on stimulus efforts in the US, hopes on, well, clarity from the Chinese economy. Sure, the overall GDP figure didn't live up to expectations, but signs that the September numbers when it comes to retail industrial production, this is a country that manages to continue to push forward. But then the moon music has turned sour. Money, though, still not finding a haven in 10-year yields. We're still a little bit higher there. Bloomberg Commodities Index up 0.25%. You were pointing out zinc earlier, Romaine. That gets a bid amid the Chinese data. We see oil basically flat. But euro versus the pound up 0.2%. Interesting as we see Brexit negotiations continue.
Yeah, and as we count down to the close here in the U.S., flip up the board because I thought one of the more interesting stories here this afternoon was a turnaround in the Russell 2000. It was actually higher for a good portion of the day. In fact, all of the sectors in that index were green at one point. Right now, all of those sectors in the Russell 2000 are red. So some of those, I guess what you would call rebound names, some of the values, some of the cyclical names that had been getting the bid earlier today and even last week on Thursday and Friday, now getting sold off a little bit. Some concerns here that U.S. fiscal stimulus bill may not materialize, or at least not anytime soon. And we're going to keep an eye here on IBM here after the close here. We're going to get earnings from them. Their big third quarter numbers. And of course, a lot of people want to get an update on the spinoff of that managed infrastructure services unit.
IBM, one to watch. Now, let's turn our attention back towards COVID and turn our attention back to you, the viewer, what you're up to, because COVID has upended our work life, our social life, and our culinary life. Has work from home upped your kitchen game, or have you seen you basically eating lunch rarely? Let's ask about how this has affected the prepared meal delivery service Freshly. It's announced it's actually expanding its manufacturing operations by opening in a new facility in Los Angeles. As sales, well, they seem to be surging amid the pandemic. Joining us now is Mike Wystrach. He is Freshly CEO. Mike, talk to us about what COVID has done to you. You're sort of more along the DoorDash, Uber Eats, Grubhub kind of the world. You're preparing meals for people. Is everyone desperate to not cook for themselves anymore?
Yeah, well, first of all, thank you for having me on today. Yeah, I mean, I think what you see is a macro trend that, you know, it's been going pre-COVID. It's certainly accelerated with COVID, which are people just are going online to do more and more things in their life, and food is a big part of that. Certainly, COVID has accelerated, you know, DoorDash, Uber Eats, and I think some of the challenges that people have with those is they're expensive. So, you know, averaging $14 per meal with delivery and all sorts of different stuff, and they tend to be unhealthy. So, you know, where Freshly fits in is we're a fully prepared meal, but we start about $8.49 per meal. It's in your refrigerator, fresh, never frozen. So all you have to do is just heat it up, and you have an amazing meal. So certainly, I think COVID, as more people have tried to stay home, it's only helped our business.
And so when we talk about businesses that have benefited from the lockdowns and the changes in consumer behavior during COVID, Mike, we always have to ask them whether you think those changes will be permanent and lasting, presumably once we get to under the other side of this COVID crisis.
Yeah, I mean, I think you've seen these trends happening pre-COVID, right? So acceleration in e-commerce, acceleration in DoorDash, Uber Eats. I mean, these businesses were growing rapidly as we were pre-COVID. I think these are accelerating those now. I think, you know, post-COVID, is there some degree of regression in the mean? Probably. But in general, I think as we go online for things, no matter what the industry is, we tend not to come back offline. So I think these trends are going to stay with us. I think, you know, food, one of the challenges was always just getting people to make that first try. And I think we've overcome that barrier because, you know, the incentives are so high to not go out right now that we've really accelerated those. But people are enjoying these new platforms more than they thought they would.
I'm curious if you can glean any insights into sort of where we are in this pandemic by what you're seeing people eat. So, for example, in the beginning, we were all eating muffins and brownies and throwing away nutrition. Are we now refocusing on nutrition? What does that sort of tell you about the customer?
Yeah, and I think you nailed it. We've seen many different cycles of COVID. I think the early days was that shelter in place, the get food anywhere you can. Oh my God, we're going to run out of food. That lasted kind of the first few weeks. Then there was this kind of comfort stage where I think the world was upended and we all wanted some degree of comfort. I think in general, across the world, people are settling into, not that this is the new norm, but it's going to be here for a while. And we're looking to get back in shape and fitness and nutrition. I think one of the things that's also somewhat disturbing is the correlation with the impact of COVID for those people in society who are a little less healthy. So specifically diabetes. So I do think that we're now seeing a much bigger inclination, a much bigger approach to saying, okay, we've got to be healthy. So I think you're seeing that as well with Peloton and different fitness industries that, people stopped going to the gym and then they said, okay, well, how are we going to come and solve this problem in a new way? And I think that's where Freshly fits in is, the comfort of getting DoorDash or Uber Eats. It certainly was convenient and easy, but I think we all found that we weren't making the healthiest decisions on those platforms. So I think now thinking about how do you get those same conveniences, but also get that elevated push on health, whereas you look at an average Freshly meal is about 40 to 50% healthier, depending on the different macros that you're looking at versus a kind of average takeout meal.
You're obviously delivering more than a million on a weekly basis in terms of meals. The expansion is clearly front and center for you. What about the price point as we do start to see the economy, of course, grind ever slower? We're seeing concerns about people's ability to continue to spend, worries about further fiscal stimulus in the consumer. How do you speak to that, Mike? How do you look at the price point and making sure it's still accessible?
Yeah, so I think price in food it's a well-proven theory, right? The elasticity curve around food is very well proven. So I think when you look at our meals at $8.49, we've actually been able to, over the years, continue to add more and more value and not increasing the charge for food. But additionally, for us, is there's no delivery costs, there's no tips. All of our employees are fully employed with healthcare benefits. So I think what we've really focused on is building a sustainable model for all participants, including the customers, but also our employees. And we're also profitable. We hit profitability actually pre-COVID. So I think, again, as you think about food is certainly, it's one of these things that we have to focus on business models where multiple different stakeholders win. And we feel our model is that, where we can continue to drive more value for the customers, but also create a real business with value for employees and that side.
We want to thank you, Mike, for the time. Keep in touch with us. Mike Wystrach, Freshly CEO. Now, in that interview, we got some breaking news, all regarding SoftBank. And remember, this was the company that was suddenly going into the public markets. Many started to believe perhaps they were a whale out there buying up, well, sort of call options in the market that were driving tech stocks higher. We understand that currently SoftBank is charging ahead with that new public stock trading arm and is now amassing some $20 billion in public stock. Remember, Romaine, it was all about $10 billion before, but now it seems as though that asset management unit is really managing to build up its strength.
Yeah, and we know when SoftBank wants to do something, they do it big, and they're certainly doing it here. But I have to wonder, Caroline and Taylor, if this kind of adds a little bit more to some of that speculation about the whale theory.
Yeah, I was wondering about that, right? If you're buying further calls, then of course the person on the other end of that has to hedge that by buying the underlying stock. So a fascinating story, of course, that we will continue to follow. And we'll do that next. This is Bloomberg. Monetary chiefs from the Euro area, Japan, and the UK were united in their concern about economies during an online seminar hosted by the Group of 30 over the weekend. They all agree that the outlook remains to the downside and that support will be needed for some time. We also heard from Atlanta Fed President Romaine Bostick on CBS's Face the Nation on that matter on Sunday. Take a listen.
Continued recovery is anticipated, which will benefit the global recovery. I think that the main risk right now we see is one is a macro leverage ratio is increasing.
The risks remain very heavily skewed towards the downside. So to borrow a phrase from sport, I'm afraid the hard yards are still to come.
If growth expectations drop and financial system becomes unstable, the economy could fall into a full-fledged recession.
If you were to graph this, after the great decline that we saw in March and April, the recovery looks something like this.
As you heard there, part of the G30 panel, global central bankers are aware, of course, of the coronavirus fallout it's not over, and then new warnings about government restrictions, struggling recoveries, and threats to jobs. And Caroline, I think what was so interesting there, Romaine Bostick, of course, making that K-shaped recovery that we so talk about, and the divergence that we've seen throughout this pandemic and the widening gap it has created between the haves and the have-nots.
Yeah, inequality is something that the Federal Reserve Chief currently, Jay Powell, has spoken a lot to, but it's also interesting just how intertwined we've seen monetary policy become with fiscal spending as well. The age-old debate of whether we'll see it here in the United States. Have they become inextricably linked to a certain extent? Will the market ever be able to basically wave goodbye to Federal Reserve support in any way?
Yeah, and I mean, Randall Quarles sort of stirred the pot a little bit last week with that. There was some great reporting on the Bloomberg today by Rich Miller, one of my favorite reporters here, and he had a great quote from Paul Tucker, of course, was the former deputy over at the Bank of England, who basically said he wants to see someone come in and basically do what Paul Volcker did for inflation expectations back in the 70s and do that today for how the market views the Fed and its role in financial stability. So interesting debate here. All right, we are counting you down to the close here. There's the clock there, 13 minutes, 36 seconds. Where do we stand right now in the markets? Right around a little bit off the lows of the days, but still pretty much a weekday here, 34.30. That's pretty much where you stand. All of the big tech names down. Apple, Microsoft, Amazon down a couple of percentage points. Pretty much every other thing with a decent weighting, Caroline, right now is deep in the red.
Yeah, and it feels as though the mood music really changed. Will we get any stimulus? It feels not every single industry group in the red. Communication services, energy, healthcare, they lead us lower. From New York, this is Bloomberg. This is Countdown to the Close, and Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
Let's check in on how those benchmarks are doing, guys, because, well, we were above water at about 10 a.m. 10:30 a.m. we started to dive below the surface into the red for all the benchmarks, really. They moved in lockstep. The outperformance of the smaller caps has remained. In the turquoise line is your Russell, but really S&P, NASDAQ, and indeed the Dow all underwater and really sold off, accelerated at about 2:30 p.m. today, Romaine.
Yeah, and I mean, there are some bright spots in this market. I mean, part of the strength that we saw earlier in the day dealt with a lot of the small cap names, particularly those in the travel, restaurant, and entertainment industries. You see at the top of your screen there, those are your travel stocks, your UAL, DAL, those still in the green on the day. There was some pretty interesting traffic data coming out showing that the TSA data showing that checkpoints had actually gone back above 1 million for a day. So that's still about 39%. 39-40% of where we were a year ago, but it's been a pretty remarkable improvement from where we were just a few months ago. Again, that second line there, though, those are your office REITs. An interesting downgrade coming in today from Evercore ISI saying that the slow pace of workers returning to offices is going to weigh on some of those stocks. The restaurant names rallying today. Cheesecake Factory, Caroline, up 6%. Dave & Buster's, Taylor's favorite, up 7.5%. She loves that skee ball.
Dave & Buster's.
I actually have gone in the last year.
What do they serve? Educate me.
It doesn't matter.
It's just like a really fun game.
It's an adult playground, that's all.
Sounds intriguing. I'm more of a cheesecake kind of a person. Let's move on. Let's get Anthony Saglimbene in here, global market strategist at Ameriprise Financial. Anthony, before we ask you about entertainment versus cheesecake, I want you to dive into these markets and talk to us about how you sort of navigate when a mood turns sour. What sparked it? Do you trade on these sorts of headlines, on this concern about fiscal spending?
Yeah, there's a lot of cross currents going through the market today. So really anticipating day-to-day moves in the market is very difficult. I think you have to take a step back and you have to look at where the trends are going. And I think some of the trends that we're seeing are fairly positive. You're seeing Friday's retail sales report, very positive. Home sales data, we're going to get a batch of home data this week. The home, existing home sales, new home sales, permits, all of that has been very positive. At the same time, labor trends have continued to improve. So I think when you take a step back, markets have been able to gravitate higher and volatility is up lower because economic activity is getting better. The one thing, and you guys have been talking about it all day, is that cyclical area of the market. That needs more support, and it needs fiscal stimulus to probably bridge it over to the other side when we're through this coronavirus. And right now, that is very up in the air. So the stimulus packages, the amount, if it's going to get passed before the election, after the election, what does the makeup of Congress and Washington look like? What does that mean for the stimulus bill? Small businesses, particularly in leisure, hospitality, restaurants, hotels, travel, they need more support. And right now, that's the big question mark. So that's on days like today, that's why you see the Russell 2000 sell off. That's why you see some of the cyclical areas like industrials and materials not perform as well. So I think that's the day-to-day movements. I think longer term, you'll see those sectors improve, but we just need to get through this virus, and a lot of that data is still mixed.
Yeah, and with regards to that longer-term picture and this idea that a lot of these stocks will sort of bounce back in short order, there's a theory out there that even if we don't get the fiscal stimulus this year or this month or in November, that as long as it comes in January, February, once either a new Trump administration, new Congress comes in, or a new Biden administration comes in, the general idea here is that there's enough consumer spending out there right now to sort of get us over the economic hump for the next 3 or 4 months until Congress and the White House manage to work something out. Do you buy into that theory at all?
Yeah, I would say it depends on who you're talking about. So if you're asking a small business owner or anybody that operates in leisure or restaurants and any of those areas, they're hurting and they need money now. So the longer it takes to get support from Washington, the more chance that those businesses go out of business, or those businesses, just go bankrupt, or you don't see the employment trends that have improved continue to improve. So I think and it's that K recovery, right? The bottom part of the economy is struggling. So I think they would argue that we need stimulus now. I think from a larger macro perspective, the market is doing pretty well. The economy is recovering, and I think those trends can continue, but I don't think it's an indefinite trend. I think for the economy overall to continue to get better, you need to bring up some of that bottom half. And right now, people are not going to restaurants at the same degree. They're not traveling. They're not getting on airplanes. Even though those trends are improving, they are still well below the levels we saw in March and April. And without that level of demand moving back up, it's going to be very difficult for those businesses to continue on for a couple more months while we wait for fiscal stimulus.
Yeah, a lot of mixed signals coming out of the economy right now. Speaking here with Anthony Saglimbene, global market strategist at Ameriprise Financial. We're going to continue that conversation with him in a moment as we count down to the close with just about 4 minutes to go. Taylor, mixed signals in the economy, also getting some mixed signals here in the market. The S&P 500 right now breaking down towards the lows of the day, but interesting to see here, not really seeing a lot of buying going on in the Treasury market.
Exactly, right? So the panic is contained because you're actually seeing yields rise, not fall. And this sort of fits into the theme that we've been talking about, fiscal stimulus. Schroeder is at least saying, as we know, fiscal stimulus is a when, not an if. They expect curve steepening in the 530s no matter who wins on election day. Right now at a 530 of a 121, they're certainly seeing a lift up from there. And we sort of fold this over into all the conversations we're having. It's my stock of the hour. I know you were looking at it as well. American Airlines, this reopening trade, right? This reflation trade, where are we in that? Despite the broader index selling off, American Airlines still up about 0.9%. They're putting the 737 MAX back on their schedule in December, pending U.S. approval. Plus, we got 1 million TSA passengers for the first time since March. So American Airlines, a stock I'm watching for the stock of the hour. And fold up the board again, I'll just show you, of course, that TSA passengers, because as we talk about the reopening, of course, and where we are, and Anthony, I will bring you back into this conversation here. TSA passengers were still down 60% year over year, but we're really slowly starting to reopen. And I am curious where you see the reopening trade, sort of that reflationary trade, as we were talking about the 530s as well. How intact is that still?
Yeah, our view is it really depends on the trajectory in COVID-19. And so some of those trends are starting to worsen a little bit in terms of case counts going up in the US. They're going up in most of Europe. So you need consumers and travelers to feel confident to get on a plane and go return to those normal activities that include larger group gatherings. And I think our view is we'll continue to see consumers kind of trend in that direction. If we get a vaccine, maybe in the front half of next year, I think you could quickly see some of these cyclical areas recover even more based on just having a vaccine, and you see us getting kind of a handle on COVID-19. But bottom line, the way we're positioning for clients and telling them how to look out over the next few months is to focus on quality companies, regardless of the industry that you're looking at. But there are opportunities in some of these cyclical areas. They have not recovered to the same degree, like say big tech or some of these consumer discretionary names. So areas in like industrials and materials and even some of the consumer discretionary and retail, there's opportunities. You just have to take a longer time horizon. You have to look out 6 or 12 months from now, because we think those trends will continue to improve, but we're going to see this ebb and flow in the data. And that's what you've seen in TSA data. That's what you've seen in some of the Fed data that looks at weekly economic indicators. It has improved, but it's improving in a very choppy manner. And I don't think that that's really going to improve to a significant extent until we see a vaccine.
How are you getting your clients to look through the election volatility as well, Anthony?
That's another thing. There's a lot of noise on the election. You look at some of the option activity out there. Traders and investors are positioning for higher volatility both right before the election and then after the election. I think what we've seen over the last couple of weeks is that maybe we will know the results in a couple of days or a week following the election. So some of that volatility has come down. I think you have to have a pragmatic approach, and you have to kind of look at on the margin how you position portfolios. Whatever administration takes office in January, they're going to have fiscal and monetary tailwinds, and they're going to have an economy that's likely rebounding.
All right, speaking here with Anthony Saglimbene, global market strategist over at Ameriprise. As we get the closing bells here in New York, guys, and you take a look on your screen there, 197 on the Dow Jones Industrial Average. S&P 500, 34.27. Keep in mind, the low of the day was 34.19. So saw a pretty significant sell-off here on the day, and no real buyers coming in here at the end. S&P down about 56 points here at the close.
Worst day for the S&P 500 since September 23rd, so basically almost a month. We remind ourselves of perhaps how we do see continued sell-off days, but perhaps not always to this extent. And notable that actually smaller caps sort of fell in lockstep, not really any outperformance there.
Yeah, I think interesting we just go cross-asset, and I think one of the best notes I read, Caroline, was if there was some really big new news, you would see it show up within bonds and currencies, and frankly, we're not. Yields are still up. Gold unchanged, dollar a little bit weaker, mostly unchanged. So perhaps an equity market issue only, at least for now. Anthony, let me bring you back in here. What's the biggest question you're getting from clients right now?
Just kind of how to handle the election. So we've spent a lot of time just kind of laying out some of the groundwork for either administration, or, you know, whether it's a Biden presidency or a Trump second term, whether Congress is divided, whether we see a blue wave. I think our overall kind of assessment of the situation is that there's probably opportunities for changes on the margin, whether, you know, we see higher taxes or we see a bigger infrastructure bill with a blue wave, and then maybe how that plays into whether you overweight U.S. assets or maybe you look at some global equities, and then obviously the strength of the dollar plays into that. But I think what we've really been trying to kind of promote with clients and our advisors is that you have to look through the election and look at some of the trends that are affecting the economy and earnings, and those trends are improving. They're still choppy, but they're improving. And, you know, we're going to move through this election volatility, and we're going to be left with what's our assessment of the economy, what's our assessment of corporate profits. And we think over the next few quarters, you're going to see that improvement. And we think that stock prices are going to react positively to that. Big question mark how much they move higher on that. But I think the overall trend over the next 12 months is that you want to overweight stocks a little bit relative to your bond investments right now, because you're just not getting paid a whole lot to hold those bond investments.
All right, Anthony, I want to get your thoughts here, too, on the earnings season. We got a little bit of a taste last week of maybe what we can expect. Of course, we get about 89 or so S&P 500 companies this particular week, including IBM, just moments away. What are you expecting in aggregate out of this earnings season?
Yeah, don't focus so much on the numbers. I think from a numbers perspective, I think EPS, earnings per share, is expected to be down around 18% for S&P 500 companies. That's materially better than what we saw in Q2. I think what we're watching and what we're expecting is that we want to see companies continue to say that they're seeing demand and trends improve. The market has basically baked in that COVID-19 is temporary, and over the next few quarters, business trends will improve. And maybe even by the time we get to the end of 2021, corporate profitability is going to be back to where it was pre-COVID. I think that's a question mark, but I think what companies say about that trend and the arc that they see over the fourth quarter and in the first couple quarters of next year, that's what investors are keying in on, because valuations have already built in that we're going to basically be back to the same profitability that we were at the end of 2021. Our view on a normalized basis, if the S&P 500 can earn about $300 or about $150 a share in earnings over the next 4 quarters, and you look at a PE multiple around 24 or so, markets are fairly priced at these levels, but that anticipates that we're going to get that bridge, we're going to get that fiscal stimulus, we're going to get on the other side, and profits are going to continue to grow. I think that's our base case, but there's still a lot of what ifs in that scenario.
Certainly are, and not just US what ifs, but global what ifs. And Anthony, you have global in your title, global market strategist. We had better, stronger data coming out of China, Japan showing that its trade was improving as well. But Europe, the COVID picture there is ugly. Where are you looking at in terms of opportunities abroad?
Yeah, our biggest opportunity set, I think, is in the U.S. and then in Asia, and that's principally China. And so you saw the Q3 GDP data this morning, you saw industrial production, fixed asset, retail sales. All of that data is showing that the picture in China is improving and that the second largest economy in the world is moving forward. And I think the U.S. is kind of a little bit behind that, but we're moving in that direction too. I think for Europe and Japan and some of the other large developed countries, they're having a harder time, with just kind of managing some of the coronavirus, but just the high debt loads across a lot of Europe, the slower growth and demographic issues that they have. It's just harder to recover and get that snapback in those economies. So I think you need to continue to be underweight Europe and Japan, but maybe less so than you were in maybe March and April. Because if we do get a cyclical recovery, a lot of their indexes are structured off of industrials and materials and financials. So if those areas of the economy benefit next year, then I think there's some tailwinds for Europe and Japan. But you just, it's all contingent on COVID right now, and those trends don't look particularly great. So we just got to continue to monitor that and probably stay where the certainty is, which is in the U.S. and China.
A global picture from Anthony, sat in front of a global picture of the world. We thank you. Beautiful map behind you, Anthony Saglimbene, global market strategist at Ameriprise Financial. More markets coverage coming up on Bloomberg Markets to Close. Where would you invest $1 million right now? We discuss that next. This is Bloomberg. So how did markets close today? On the downside. In fact, the worst day that we've seen since September 23rd, it would seem, for the S&P 500. So sell-off across the industry groups, but as the big communication companies, the likes of Apple, Amazon, Facebook, all on the downside, dragging the main benchmarks lower. Taylor.
Well, Caroline, we all wish we had $1 million, right? But if we did, where would we invest it? Especially with COVID-19 impacting many of our everyday decisions. Here to help answer that question, Bloomberg Wealth reporter Devin Pendleton. Devin, what I loved is you were part of a series on where to invest $1 million right now. 6 experts offered investment ideas for a post-pandemic future. And one that caught my eye was sort of the sale and lease back of airplanes, really with smaller planes, because as international travel has been crippled with some of the jumbo jets, you really have some of those single aisle planes still rebounding. What did you glean from this and some of the other experts that you interviewed?
Yeah, well, there's a lot of ways to look for dislocations caused by COVID crisis and the pandemic, sort of finding silver linings in terms of investments. One idea which struck me as quite interesting is looking at warehousing space, and its numbers are really striking about the demand for industrial warehouse just going through the roof, because you see e-commerce sales surging like never before. You have so many people buying online that you just need that much more warehouse space for inventory. So actually buying warehouses as a real estate play is one very attractive option. And then
let me stop you there for 1
e-bikes.
second, Devin,
Yeah.
because the person who you interviewed, that was interviewed in that, Eric Becker over at Crescent, kind of talked up that industrial play. He also mentioned this idea of starting a dinosaur fossil collection.
Yeah.
What's that about?
He did totally other end of the spectrum.
Yeah.
I mean, something just kind
That's
of
a
for fun,
contrarian
something you're
play.
very passionate about. Yeah. I mean, he had lovely memories of when he was a kid going to sort of semi-professional archaeological digs with his parents and going to the beach and finding these incredible fossils, and it stayed with him. And what they say is, you know, if you're going to invest in a passion, it has to be something you really love. You love spending time with, and you love getting to learn a lot about it. And, you know, actually fossils are becoming collectibles. You just had a recent Danny the T-Rex fetching in the millions.
And,
So
you know what's great about that, Caroline?
What?
If you get that fossil collection, then you need industrial storage space to store it all.
It just sews in so nicely into his overall investment thesis. But Devin, to your point, you know, maybe one needs to get very passionate about, well, corporate disaster stories, it would seem, as well, because one of your investors that you were looking at and speaking to, Akshay Shah, CIO and founder of Kima Capital, he's saying, actually, start to look for memorabilia of businesses that have gone under.
Yeah, a little bit of a macabre take on investing, but very clever. I mean, you actually, on eBay for a while, there were these Post-it notes, Lehman Brothers branded Post-it notes that were going for $500 a piece. And if you think it would be funny. I mean, to have these ancient throwback mouse pads and other mementos. And there's a whole host of companies.
Devin, this is a fantastic story. I'll really urge our viewers to go to check it out. That's Bloomberg, Devin Pendleton there. Breaking news crossing the wire here. IBM earnings are crossing the wire at the moment. At least on the surface, it appears to be a beat. 3Q revenue coming in at $17.6 billion. Remember, they pre-announced, so some of these numbers were already known. Operating EPS at $2.58, excuse me. That's the same, again, as what they reported earlier. That gross margin coming in at 49%, slightly above the estimate of 48.6%. And we should point out that Global Technology Services, Caroline, at $6.46 billion. That's slightly ahead of evidence. They also have that cloud business that a lot of people were focused on as well.
I mean, this is where they're putting front and center, right? It's all about the hybrid cloud. It's all about focusing on the next iteration of IBM under the stewardship of the CEO, Arvind Krishna. Of course, been chief executive since Ginny Rometty stood down. She's now still leading from a chair perspective. But this is, he says, a strong performance of our cloud business led by the Red Hat. That was a major acquisition they did a couple of years ago. Underscores the growing client adoption, they say, of their open hybrid cloud platform. But really what every investor wants to learn a little bit more about is how the company is going to be splitting itself in two, how it's going to be spinning off, of course, other parts of the business that don't have as high a margin.
Yeah, and you know, Taylor, the interesting thing, I mean, we were speaking with Anthony Saglimbene a little bit earlier, and he was talking about this idea that you really have to sort of look not only at the forward guidance, but really the language these companies use. So I don't know how much we can glean just from the statement, and maybe we do have to wait for the conference call. I mean, what do you think about this?
Conference call, always.
Yeah.
That's when you get to hear as well from what the analysts are asking, and I think really get some indications on what management really is thinking, Romaine.
Yeah, and I see some other news here crossing the wire, Caroline.
Ireland. Again, keeping it close to home or where we come from, but Ireland to close most stores, bars and restaurants on the virus. This as Ireland imposes some of the strictest COVID clampdowns once again in Europe, and they will close most of the stores, they say, and this is going to be a 6-week-long tie-up, it would seem, for the economy and indeed for those that live within Ireland, Romaine.
All right, let's jump over now to the first word news with Mark Crumpton. Mark.
Romaine, Caroline Taylor, thank you very much. Mayor Lori Lightfoot warned Chicagoans that the city is experiencing another wave of the coronavirus, with confirmed cases rising sharply across the city to levels last seen in late spring. At a press conference today, Mayor Lightfoot warned, quote, "Make no mistake, we are in a second surge."
Daily cases have expanded to an average of over 500 new cases every day, which is more than a 50% increase since the beginning of this month. This is the highest daily rate we've seen in Chicago since the tail end of the pandemic's first wave back in May. And it's coinciding with a worrying increase in hospitalizations.
And Mayor Lightfoot added that with acute increases in coronavirus cases happening across the city among all age groups and races, Chicago may not be able to reduce the spread of the deadly illness with so-called targeted restrictions. Despite her dire warning that the pandemic was heading toward another peak of infections, sickness, and death, Mayor Lightfoot ordered no new restrictions on businesses and gatherings to stop the spread of COVID-19. Senior Palestinian official Saeb Erekat is in critical condition with the coronavirus. The Israeli hospital where he's being treated says the 65-year-old Erekat was placed in a medically induced coma and put on a ventilator. Mr. Erekat, who has long supported nonviolence and the two-state solution, has been intimately involved in Palestinian politics and Israeli-Palestinian negotiations for decades. The government of Wales today announced a 2-week lockdown aimed at curbing the spread of coronavirus. Everyone in Wales will be required to stay at home between October 23rd and November 9th, and all pubs, restaurants, and non-essential retail outlets will be closed.
This firebreak is the shortest we can make it, but that means that it will have to be sharp and deep in order to have the impact we need it to have on the virus.
The moves by the Welsh government come as Prime Minister Boris Johnson insisted he doesn't want similar measures across the border in England. The U.S. Treasury Secretary Steven Mnuchin and House Speaker Nancy Pelosi resumed their calls today to discuss a fiscal stimulus deal. Pelosi has warned that unless there were signs of progress from the White House by tomorrow, there won't be an agreement before Election Day. The White House says if Speaker Pelosi is reasonable, she'll find President Trump will be reasonable too. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
We have to pivot to oil. Of course, with the OPEC Plus meeting, global demand, it's been rebounding a little bit, but nowhere near pre-pandemic levels. What that means is prices of oil, of course, range bound. That's in white. But take a look in blue. That's energy stocks relative to the S&P 500. They are at record lows. All, of course, perhaps why we're also seeing ConocoPhillips buying Concho for almost $10 billion, all because you need to be bigger and better to survive in this industry. For more on this OPEC Plus meeting and, of course, the outlook for prices and production, let's bring in Yasmina Kellerman, who leads our oil markets coverage here in the U.S. What insight did you glean, of course, from the OPEC Plus meeting?
Well, they're watching the same thing that all of us are watching, which is when are we going to be released from the grip of coronavirus? And I think we were all hoping, oil markets included, that we were going to be a lot better off, a lot further along in terms of a recovery at this time of the year than we have been. And right now, with all of the headlines of different lockdowns coming back into effect across Europe and, of course, across the United States, there really isn't right now a bright spot outside of China, which has been able to bring it under control somewhat, for returning demand. So given that, everyone's really wondering, are they going to go ahead with their plans to bring back 2 million barrels starting from January?
Certainly very sobering when we see what Ireland, for example, is just announcing now, basically relocking down, is the better way of saying it. Talk to us about what has been uttered, particularly by Saudi Arabia, in terms of wanting to pull together, somehow manage to support the price, but it doesn't look like what's being fleshed out in terms of the deal is really supporting that, Yasmina.
Well, at this point, they're keeping their cards pretty close to their chest. If you look at what they've said today, they are definitely acknowledging that the market is not where they want it to be. You saw Saudi Arabia say, we know for certain that it's uncertain, and we have to be able to take measures to head off negative trends and developments, to nip them in the bud. So there definitely is an acknowledgement on their part that the market is a lot more, the recovery rather, is a lot more fragile than they were hoping that it would be at this time of year. And remember that Libya, at the time that they put their plans forth, Libya at the time was not really producing, and now they're bringing back up to as much as 500,000 barrels a day, which has added to the calculation. So while they're not saying it outright, they are definitely speaking at least to the market, which has been warning it the past couple of weeks that they really don't see where the demand's going to come to support these new barrels.
We want to thank you, Yasmina, taking us through the oil market and see what we'll see unveiled by OPEC+. Of course, Yasmina Kelman of Bloomberg News. Sticking with energy, ConocoPhillips, well, it's buying shale producer Concho Resources in a $9.7 billion deal. Now, CEO Ryan Lance spoke with Bloomberg about the deal earlier.
We've been talking about the need for consolidation in the business for quite some time. We need to put a value proposition and scale and size and resource quality together that really offers investors a different way to think about the E&P space. And that's what really done this with a transformative acquisition with Concho Resources, a great company that Tim Leach has built over a number of years. Just brings in a bunch of low-cost supply resource, 23 billion barrels into the company. It's about the assets. It's about a super strong balance sheet to really manage through the volatility that we see in this business. It's about how you allocate capital for value, not for growth. It's the distributions that we're committing to give back to the shareholder, and really it's about having a sustainable business that deals with what we know is an energy transition that's coming for our planet.
So can you give me some insight as to how competitive it was? Because if we really look at the shale companies that are worth buying, there's really only a handful, and Concho was one of them. So give me some perspective on that.
Yeah, so we're after quality. This is really putting two super quality companies together to create something that's really special in the E&P space. And when we talked about it, we're looking for companies, and we've said this repeatedly to the market, the all-in cost of the acquisition needs to be below our $50 cost of supply threshold. And then the ongoing development to compete for capital investment in the company needs to be below $40 cost supply. So that's the kind of resource that we're adding with Concho's huge position in the Permian Basin, both in the Delaware and in the Midland Basins. It's a great complement to our existing unconventional position. So we're going to be a unique company in this space with a huge position in the Eagle Ford, a large position in the Bakken, and now a super large position in the Permian Basin, along with our growing position up in the Montney in California. So we'll become one of the largest unconventional producers in the business today.
Ryan, good morning. It's Guy. The hurdle rate for many investors to put money to work in your sector is increasingly high. Can you just talk to me about what investors are telling you about this deal and why it makes sense? Why would I want to put money to work in your company, given all the headwinds that the sector faces? And how does this deal change that sort of calculation?
Well, I think, Guy, you have to look at the shareholder-friendly value proposition that we put forward. So we're going to modestly grow the top line of the company, and we're going to do that only on 70% of our cash flow. 30% of that's going to go back to the shareholder. And then you underpin that with a safe, growing, stable dividend that we offer, and you suggest the yield on that today. And you look at that free cash flow yield combined with that dividend yield, combined with top-line growth. We think we're putting a value proposition out there that competes for value investors in this space. We're going to be able to do that through the cycle because of the strong balance sheet that we have. We can't predict what the prices are going to be, but we know if we're investing in low cost of supply resources, we can be resilient to that and have the balance sheet to manage through these different ups and downs. And that's what we're combining: great assets, great balance sheets together. And that's what makes it different. These are two great quality companies coming together to form an even better company going forward.
Hey, Ryan, not to get too nerdy for you at 10:04 in the morning, but something that Conoco is quite good at are decline rates and managing decline rates. Basically, it's how quickly the well loses momentum. The lower, the better. You guys are pretty good, around 14%, if I'm correct, but Concho has a higher decline rate. Actually, I think Conoco's less than 14, but Concho has a higher decline rate. How are you going to manage it? How do you think about that?
Well, that's a great question, because that goes to the capital intensity. How much capital do you have to put back in to at least make your production flat, and then how much capital do you have to put in to grow? And we've got one of the lowest decline rates in the business because of our global diverse portfolio with this great unconventional production base, but also with these legacy assets around the whole world. Today, our decline rate's just about a little over 10% per year. This only moves it up to slightly right at 12%, and that's really over the next decade.
ConocoPhillips Chairman and CEO Brian Lantz speaking there to Bloomberg a little bit earlier. And that does it for Bloomberg Markets to Close coverage. It does it for me, but stay tuned. What'd you miss? It's coming up next. Joe Weisenthal set to join Caroline and Romaine. 30 seconds, you guys. What's the number one theme you'll discuss?
Bolivia.
Yeah, and indeed.
You weren't expecting that, were you?
No, we have a cool chart on the bonds, though.
We're going global, and I think also these headlines coming out of Ireland, the focus on Brexit as well. We're getting outside of the United States for once. We're not talking about the election here, we're talking about elections everywhere else, Taylor.
I love it. You're going global. I'm going to go to Dave & Buster's just for Romaine. This is Bloomberg.